Greetings and welcome to the CBRE Fourth Quarter 2025 Earnings Conference Call and Webcast. At this time, all participants are in listen-only mode. A question-and-answer session will follow the formal presentation. You may be placed into question queue at any time by pressing star one on your telephone keypad, and we ask that you please ask one question, one follow-up, then return to the queue. As a reminder, this conference is being recorded. If anyone should require operator assistance, please press star zero. It's now my pleasure to turn the call over to Chandni Luthra, Global Head of FP&A and Investor Relations. Please go ahead.
Good morning, everyone, and welcome to CBRE's Fourth Quarter 2025 Earnings Conference Call. Earlier today, we posted a presentation deck on our website that you can use to follow along with our prepared remarks and an Excel file that contains additional supplemental materials. Today's presentation contains forward-looking statements, including, without limitation, statements concerning our business outlook, business plans, seasonality, and capital allocation strategy, as well as our earnings and cash flow outlook. These statements involve risks and uncertainties that may cause actual results and trends to differ materially. For a full discussion of the risks and other factors that may impact these statements, please refer to this morning's earnings release and our SEC filings. We've provided reconciliations of the non-GAAP financial measures discussed on our call to the most directly comparable GAAP measures, together with explanations of these measures in our presentation deck appendix. Throughout our remarks, when we cite financial performance relative to expectations, we are referring to actual results against the outlook we provided on our third quarter 2025 earnings call in October, unless otherwise noted. Also, as a reminder, our resilient businesses include facilities management, project management, property management, loan servicing, valuations, other portfolio services, and recurring investment management fees. Our transactional businesses comprise property sales, leasing, mortgage origination, carried interest, and incentive fee in the investment management business, and development fee. I'm joined on today's call by Bob Sulentic, our Chair and CEO, and Emma Giamartino, our Chief Financial Officer. Now, please turn to slide 3 as I turn the call over to Bob.
Thank you, Chandni, and good morning, everyone. We had a strong end to 2025. Fourth quarter revenue and core EPS rose by double digits, with both reaching their highest levels ever for CBRE. Our strength was broad-based. We saw significant gains in sales and leasing in the U.S. and much of the rest of the world, and our resilient businesses continued to post double-digit revenue growth, a trend we see continuing. From a strategic perspective, we continued to build businesses that are benefiting from secular tailwinds. An example is the Pierce Services acquisition in November, which expanded our technical services capabilities in the digital infrastructure market. Our data center solutions business is another example. We've created an integrated offering for the most important hyperscalers. This business consists of services related to a data center's technical infrastructure, called the white space, and the building operating systems, called the gray space, along with traditional facilities management services. Revenue from this business is expected to reach $2 billion in 2026 and is growing at 20% per year. More broadly, data center and digital infrastructure work across our 4 business segments accounted for approximately 14% of our core EBITDA in 2025. CBRE is positioned for strong, sustained growth. We are taking advantage of this circumstance to streamline our operations while investing to ensure this growth continues further into the future. We expect another good year in 2026 with core EPS in the range of $7.30 to $7.60, reflecting 17% growth at the midpoint of the range. This will be driven by healthy growth in both our resilient and transactional businesses. Before I turn the call over to Emma, I want to address AI. We spend a lot of time thinking about this topic, and we know it's top of mind for investors. I'll begin with how we are using AI in our business today, and will then walk through market-facing risks and opportunities that we see related to AI. We are using AI today in two areas. The first is efficiency. We're deploying AI where its economic value clearly exceeds the economic value of traditional efficiency levers like offshoring. We're very disciplined about understanding the trade-offs before pursuing efficiency-related AI investments. The second area is developing a knowledge advantage to differentiate our product offerings. CBRE has more real estate data than any company in the world. Historically, we have not been able to turn this enormous base of knowledge into a comparably large competitive advantage. With the use of AI, we are moving toward gaining advantages that are more in proportion to the data advantage that comes with our market position. We are encouraged in a balanced way by both of these AI-related opportunities. With regard to the market-facing risks and opportunities AI introduces to our business, we think about the risks in three broad areas. First, our transactional businesses. Second, the businesses in which we create and improve physical assets. And third, the businesses in which we operate assets. The transactional and investment work we do is most protected from AI disruption. For instance, we've known for some time that our opportunity in the brokerage business is enabled by, but not anchored to market data. This same dynamic is in play in our REI businesses. Clients engage CBRE to plan and execute complex transactions because of our creativity, strategic thinking, negotiating skills, deep base of market knowledge, and broad relationships. None of this seems likely to be replaced by AI in the foreseeable future. The physical creation and improvement of assets, which relates to our development and project management businesses, entails a level of complexity across such things as site assemblage and entitlement, strategic planning, cost analysis, knowledge of vendor capabilities and pricing, construction supervision, negotiating skills, and more. Because of that complexity and the physical nature of this business, we believe what we do is materially protected from disintermediation. Finally, we have the operation of buildings, facilities, and property management, which inherently involves both large amounts of data and information and has a labor-intensive element to it. AI can both enable and disintermediate the data and knowledge side of this. We believe the scale and complexity of our client relationships is helpful in mitigating this risk. The labor-intensive side will not be easy for AI to disintermediate. On the market-facing side, we believe there is and will be massive opportunity with owners and operators of data centers and digital infrastructure. We serve those owners and operators in a myriad of ways. We have a strong start in building these capabilities as evidenced by the results we delivered in 2025. On balance, when you add all of this up, there will be risks, risk mitigants, and opportunities in our business associated with AI. We are optimistic that the net impact will benefit CBRE in the long run. Early empirical evidence is supportive of this view. With that, Emma will discuss our outlook and results for the quarter and the year in detail. Emma?
Thank you, Bob, and good morning, everyone. CBRE's strong fourth quarter saw revenue increase 12%, with both resilient and transactional businesses delivering double-digit growth. Core EBITDA rose 19% for the quarter, while core EPS increased 18%. In advisory services, we saw continued double-digit growth in both leasing and sales. Leasing revenue grew 14% globally. EMEA led the way, with Continental Europe up 29% and the UK up 16%. The U.S. showed continued strength, growing leasing revenue 12% overall, supported by data centers, which more than doubled, and industrial, which was up 20%. Demand for big box logistics facilities, a market segment where CBRE has a deep presence, accelerated meaningfully, while 3PLs continued to exhibit a strong appetite for space. In Q4, we saw large industrial occupiers act in advance of upcoming lease expirations, often upgrading their space. U.S. office leasing revenue remained strong, in line with our expectations, reaching record levels for both the quarter and full year. Year-over-year office leasing growth decelerated to low single digits versus a then record Q4 in 2024. We saw some large deals slip into 2026, which we expect to benefit our first quarter results. In capital markets, both sales and commercial mortgage originations grew at high teens rates. U.S. sales revenue increased 27%, driven by office and multifamily. However, revenue from both asset classes still remain well below prior peak levels. Outside the U.S., sales were strong in India and the U.K. Mortgage origination fees grew over 20%, supported by a 23% rise in loan volume led by increased activity with debt funds and CMBS. Advisory SOP grew 14%, outpacing revenue growth. Excluding the impact of lower escrow income, operating leverage was even more significant. Turning to the building operations and experience segment, revenue growth was driven by local facilities management, data center solutions, and contributions from the Pearce Services acquisition. As Bob highlighted, we are seeing the benefits of our investment in data center solutions, where revenue grew by more than 20%. Local facilities management continued to deliver strong mid-teens growth, driven primarily by the ongoing expansion in the Americas, as well as notable strength in Western Europe. Enterprise facilities management growth was led by the life sciences, healthcare, and financial services sectors. BOE segment operating profit grew 20%, outpacing revenue. Turning to project management, we delivered solid revenue growth underpinned by new real estate projects for hyperscalers in the U.S. and new infrastructure mandates in the U.K. public sector. The integration of Turner & Townsend and CBRE's legacy business continues to proceed well, and our project management segment is now largely operating as a combined business around the world. As we anticipated, margins declined compared with the prior year due to a few unusual one-time expenses. The segment delivered healthy operating leverage for the full year. Turning to our real estate investment segment, SOP showed strong growth, driven by the sale of data center sites in our development business. We still have embedded gains of about $900 million in our development portfolio. Investment management operating profit was largely in line with expectations. Growth in recurring asset management fees was offset by lower incentive fees and co-investment returns than in the prior year. We raised over $11 billion in capital in 2025, and AUM ended the year at $155 billion, up more than $9 billion for the year. Before moving to cash flow and capital allocation, I want to point out a couple of items that reduced GAAP earnings for the quarter. The first is the non-cash impact of the buyout of our UK pension plan, which will result in future net cash savings. The second is an increased reserve for fire safety remediation in the UK development business. Together, these totaled $279 million. Without them, Q4 GAAP net income would have increased 43%. Looking at our cash flow, we generated nearly $1.7 billion of free cash flow in 2025, reflecting 86% conversion on core net income, slightly above our 75% to 85% target range. Since the end of the third quarter, we have allocated more than $1.5 billion of capital. This includes about $1.2 billion for the Pearce Services acquisition and nearly $400 million for share repurchases. Share buybacks have totaled more than $1 billion since the beginning of 2025. Net leverage ended the year at 1.2 turns. As Bob indicated, we expect to generate core EPS in the range of $7.30 to $7.60 for 2026. This represents 17% growth at the midpoint, supported by continued double-digit revenue growth in our resilient businesses and greater than through-cycle growth in our transactional businesses. In our advisory segment, we expect low teens SOP growth to be supported by solid increases in leasing and sales activity. As we move further into the recovery cycle, transaction revenue growth will begin to slow from the prior year's elevated levels. In our BOE segment, we anticipate mid-teens SOP growth driven by strength in our data center solutions business, our local facilities management business, and full-year contributions from Pure Services. We are focused on sustaining the significant margin gains made in 2025 while we are investing in future growth. In project management, we expect low teens SOP growth. The complex integration of Turner & Townsend and legacy CBRE project management should be largely complete this year. In real estate investments, we expect both investment management and development operating profit to roughly match our strong 2025 results. We continue to see demand from hyperscalers for sites that can be developed for data centers. However, as we've discussed in the past, it can be difficult to predict when we will complete these land sales due to the long lead times required to secure power. As Bob mentioned, we're positioned for sustained growth and are taking advantage of this position to invest in our functional platform and products. This includes launching a finance transformation, which will include an ERP implementation, process standardization, and organizational restructuring. We are also making further organic investments across many parts of our business to support the strong mid-teens EPS growth we expect to deliver this year and beyond. In addition to data center solutions, we're expanding our local business in the Americas, which has grown revenue from $330 million in 2021 to $800 million in 2025. Our industrious business is growing profitably and will expand to more than 300 locations by year-end, up from about 200 when we acquired the business at the beginning of 2025. We're also building out our Americas infrastructure capabilities in the project management business. Traditional infrastructure is growing rapidly, but comprises far less of the segment's total revenue in the Americas than the 25% it contributes across the rest of the world. Finally, our strong growth in Q4 has continued through the first 6 weeks of the year across our services segments. Advisory, BOE, and project management are expected to deliver double-digit SOP growth in the first quarter. Advisory is showing particularly notable strength for Q1, historically its slowest period. As a result, we expect Q1 to comprise approximately 15% of our full-year core EPS, a larger percentage contribution than in last year's Q1. With that, operator, we'll open the call for questions.
Thank you. We'll now be conducting a question-and-answer session. If you'd like to be placed in the question queue, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you'd like to move your question from the queue. As a reminder, we ask you please ask one question, one follow-up, then return to the queue. Our first question today is coming from Stephen Sheldon from William Blair. Your line is now live.
Hey, good morning. Thanks for taking my questions, and really appreciate the commentary around AI opportunities and risk, Bob. I highly agree with your take. Maybe just starting in capital markets, I mean, can you just give some more detail on what you're seeing in the pipeline and what you've baked into the guidance for 2027? Sounds like you're off to a strong start for the year. And I guess, how dependent do you think a continued recovery and activity will be on the interest rate trajectory? And specifically, do we need any additional rate cuts for activity to continue picking up, in your view, or are there plenty of other factors that just support activity? Just generally, how are you thinking about it?
Yeah, Stephen, we're not counting on that business being driven by interest rate cuts in 2026 at this point. What we do see is that the demand between, or the balance between asking prices and offering prices has closed. There is capital available, even though not more inexpensively, materially than it was recently. And there's a lot of buyers out there that want to buy assets and sellers that want to sell assets. And as a result, we expect another good year for sales and financing activity in our business this year. But it won't return. This isn't a business that's rapidly returning to peak levels like some of our other businesses. We've said in prior quarters that we expect this to be a slow, steady recovery. We still feel that way. Emma, in her prepared remarks, noted that the first quarter has started out strong, and we're encouraged by that. But we don't expect to see a big rapid rise in that part of our business this year, just some nice double-digit growth.
Got it. That's helpful. And then maybe for Emma, and apologies if I missed this, but can you just give some more detail on the one-time expenses that weighed on project management margins in the quarter? And will there be any flow-through impact from those, I guess? Are they truly one-time for the fourth quarter, or is there going to be any flow-through impact into early 2026?
Sure. I'll start with saying we believe that those will be entirely reversed in the first quarter. So you'll see nice margin expansion in project management. In Q4, as we were going through the balance sheet, we did take a pretty conservative view on some of the receivables on some of our larger projects. And we now think that will be reversed.
Thank you. Our next question today is coming from Julian Blouin from Goldman Sachs. Your line is now live.
Thank you for taking my question. Bob, I wanted to dig into your comments around the brokerage businesses sort of being hardest to disintermediate by AI. I think broadly the thought out in the market was that this was maybe where the risk was greatest, given the ability of AI to sort of empower sales lead generations, perhaps automate other parts of a sales process. Do you think there's a risk that AI maybe eats into some of these more market-making aspects of your brokerage business?
Well, Julian, we've watched this business for years with people saying things like, gosh, with the scale you have, with the client relationships you have, with the data you have, shouldn't you be able to shift the economics between the brokers and the company? That's been part of the dialogue over the years. And if you go back and listen to my comments over the last several years, I've always said that's not what we're trying to do. What we're trying to do is enable our brokers, because what we know our clients want is certain things the brokers bring to the table that we enable, but the brokers bring to the table. The ability to provide strategic input to big, complex transactions. We're not selling $2 million condos. These are big, complex transactions that we're doing. The ability to negotiate, experience in doing these big, complex transactions, relationships in the market. We don't get our brokerage leads online somewhere. We get our brokerage leads because of deep knowledge about the occupiers and investors in the marketplace that we serve. So we've become quite confident that business really is driven by this strategic, creative thinking that our brokers do. And we think that's going to continue to be the case. And we haven't seen any evidence to the contrary. What we're really working hard to do and thinking we're finally making some gains on using AI is to provide data to our brokers in a more efficient way and a more cost-effective way for us. It is expensive to collect and provide this data to our brokers from the different sources. We think we've turned the corner on that with the use of AI. We're pretty encouraged in some tools we've built. But the thing that the clients buy from us is creative, strategic thinking, negotiating skills, et cetera. It's the same set of skills that go into our investment businesses, which are going to, and that's development and investment management, which are going to make those difficult to disintermediate.
Thank you. No, that's really helpful. Emma, I wanted to maybe check on the advisory services sort of incremental margins. They appeared lower this quarter. I know you mentioned the lower escrow income. I guess how much of that, or what would the incremental margins have looked like absent the lower escrow income, versus is there any sort of impact here from compensation or sort of fee pressures? And then what kind of incremental margins are you assuming in 2026 in advisory?
So Julian, to answer the second half of your question around escrow interest, without the escrow interest, which declined this quarter as interest rates declined, our incremental margins were above 30%, which we view as very strong. And I think what we have to keep in mind is we have industry-leading margins in this business, as we do across all of our segments, and we consistently grow above the market. So we're consistently gaining market share, and to do that, we have to continue to invest in the business. Just like Bob just talked about, investing in our data for our brokers and our platforms, we're consistently doing that. We're also investing in talent to be able to outperform the market. You have to have the best talent in the industry. So we're making all of those investments, and looking to 2026, we expect to continue to do the same.
Thank you. Next question today is coming from Anthony Paolone from JPMorgan Chase. Your line is now live.
Yeah, thank you. Bob, thanks for the comments on AI related to CBRE. Can you talk maybe a bit more about what you think the impact might be on your end markets, particularly around office, and whether you see any long-term diminution in that, just in terms of overall space needs, and perhaps also in areas like appraisal, which can maybe get streamlined and perhaps reduce fees or something there?
Well, Tony, two very different questions. Let me start with office. If there are less office workers in the long run as a result of AI, there will be less demand for office space. That would be a long-term trend to unfold. What we're seeing right now is tech companies, financial companies, advisory companies, every kind of company you can imagine is using their office space to attract talent and make talent more efficient and effective and excited to come in and go to work. And that's created a lot of opportunity for us. Over the last 5 quarters, we've gone from, on Main and Main, there's more demand for office space, to Main and Main in, the gateway markets. Well, then it's Main and Main plus, and the gateway markets plus. Now what we're seeing is across primary and secondary and tertiary markets, a lot of demand for office space because workers have come back and companies are using office space to support those workers in all the ways I said at the outset of this answer. In the long run, will there be less office users?